Is Ubiquiti Inc. The ultimate networking strong buy of the year? Or is it, a dangerous, overvalued trap just waiting to collapse on retail traders?
Yeah, that's the big question right now.
Right, because you look at the chart and the stock has gone completely parabolic. But,
Yeah.
but if you look a little closer at the underlying valuation, some of the smartest money in the room is sounding a massive alarm.
They absolutely are. I mean, we are looking at a really profound market contradiction here. We have incredible, almost gravity-defying technical momentum on one side.
Oh, completely defying gravity.
Exactly. And it's warring against some incredibly sobering fundamental red flags and, well, insider sell-offs on the other.
Welcome to this deep dive. To get to the bottom of all this, we have a massive stack of data for you to unpack today.
A lot to get through.
We've got trailing 12-month financials, technical indicators, analyst consensus models, and the raw insider trading logs, too. We are going to figure out the mechanics driving Ubiquiti's or UI's wild price action.
And we really need to look under the hood to see what's real here.
Definitely. Just as a quick reminder before we get into the actual numbers, this is a natural human debate to explore the data. We're analyzing market mechanics, but absolutely no financial advice is being given.
Right, we're just laying out the architecture of the stocks movement, so you can draw your own conclusions.
Exactly. And hey, if you find this kind of rigorous breakdown valuable, make sure to like the video and subscribe to our YouTube channel. Also, please leave your feedback in the comments. We say it's compulsory because your comments literally dictate the financial models and the stocks we tear down in future deep dives. We really do read them all.
We really do.
Okay, let's unpack this. Before we even touch the controversy or, the analysts predicting a massive crash, we have to isolate the actual money-making engine driving the price.
The fundamental.
Right. So as of April 10th, 2026, the stock closed at $925.70.
Which is just a staggering psychological level when you look at the wider context. I mean, the stock is currently sitting mere inches away from its 52-week high of $931.60.
It's so close.
Yeah, but the metric that really establishes the sheer velocity of this move is the 52-week low. A year ago, this asset was trading at $282.82.
A climb from 282 to over 925. I mean, it's like watching a sports car redline. It's thrilling, but you have to wonder if the engine is about to just blow. When a stock triples its market cap in 12 months, the immediate assumption is that they must have, invented cold fusion or secured a complete monopoly.
Right, some massive paradigm shift.
Yeah, but looking at the trailing 12-month income statement, they're literally just selling physical networking gear. Total revenue sits at $2.97 billion, pulling in $888.63 million in net income.
Which is huge.
It is. That gives them a diluted earnings per share of $14.67.
The revenue is solid, but the metric you really need to isolate there is the net profit margin.
Yeah.
They are operating at a 29.90% net profit margin.
Nearly 30%.
Yeah, nearly 30%. What's fascinating here is how structurally difficult that is to achieve in the hardware sector.
Because physical hardware isn't software. Like if you build a cloud software platform, your gross margins can easily hit 80%.
Oh, easily, yeah.
Because spinning up a new server instance for a new customer costs fractions of a cent.
Yeah.
But Ubiquiti is manufacturing routers, switches, and enterprise access points. You have raw materials, silicon, shipping logistics, warehousing. How do they mechanically squeeze 30% pure profit out of that?
It comes down to a really unconventional operating model. Unlike massive competitors like Cisco, for example, Ubiquiti notoriously employs almost zero traditional direct sales force.
Wow.
Yeah. They don't have armies of sales reps taking enterprise clients out to steak dinners. They rely heavily on community-driven support forums and organic evangelism among network engineers.
That's fascinating.
It is. By stripping out the massive SG&A selling general and administrative expenses that typically burden enterprise hardware companies, they just funnel those savings directly to the bottom line.
So they essentially crowdsourced their sales and customer service to their own highly technical user base. Well, that explains the income statement, but let's look at the balance sheet for Q2 2026. Total assets are at $1.61 billion, with $302.82 million in total cash. But they do carry $1.06 billion in total debt. On the surface, carrying $1 billion in debt when you only have $300 million in cash Sounds pretty precarious.
It sounds precarious until you evaluate how that debt is serviced. You have to look at the debt-to-equity ratio, which sits at a very manageable 11.46%.
Okay, that's not bad.
Not at all. But more importantly, you have to look at the cash velocity. Over the trailing 12 months, they generated $516.78 million in levered free cash flow. In just Q2 2026 alone, they pulled in $260.27 million.
Well, let's break down that levered free cash flow mechanically, because that isn't just revenue, right?
No, not at all.
Levered free cash flow is the actual cash the business has left over after it has paid all of its operating expenses and met all its financial obligations, including the interest payments on that $1.06 billion debt.
Right.
It is the money that is truly free and clear for equity shareholders.
Precisely. Because their levered free cash flow is so robust, the debt load is functionally neutralized as a risk factor right now. In fact, that massive cash generation is exactly what gave them the leverage to introduce a new 80-cent cash dividend.
But hold on, an 80-cent dividend on a $925 stock is a yield of roughly 0.35%. That is negligible. Why even bother instituting a dividend that low?
It functions as a financial signaling mechanism. By instituting a dividend, even a fractional one, the board of directors is signaling to institutional investors that their cash generation is not a temporary anomaly.
Oh, I see.
It communicates structural permanence. They are effectively saying, we have so much free cash flowing through the system that we can begin returning capital to shareholders without sacrificing our R&D budget.
Okay, so the underlying company is remarkably efficient. They are a cash printing machine. But efficiency alone does not explain the sheer madness of the current chart. UI has gained roughly 19% in the last 2 weeks alone.
Yeah, the chart is wild right now.
We need to look at the technical analysis to see if the market mechanics actually support this, or if the algorithms are just blindingly chasing momentum. So what does this all mean for the person looking at the chart today? Is buying now like trying to jump onto a speeding train?
If you look at the quantitative data, the technicals are painting a picture of aggressive, almost unhinged momentum. The current signal across the board is a strong buy.
Let's quantify that momentum. The MACD, the moving average convergence divergence, is currently at 17.96, which confirms a bullish crossover. But let's look at the mechanics of why that matters.
Right, it's not just a random number.
Exactly. The MACD isn't just a random oscillator. It measures the relationship between a short-term moving average and a long-term moving average. When we see a reading like 17.96, it means the short-term price action is pulling away from the historical trend at an accelerating velocity.
And you can see that acceleration vividly when you plot the standard moving averages. The 50-day moving average is all the way down at $748.40.
Wow.
Yeah, and the 200-day moving average is even deeper, sitting at $607.67. The current price of $925 is hundreds of dollars removed from its own historical baselines.
Which brings us to the most glaring warning light on the dashboard. With the 14-day RSI pushing up to 71.32, we are deep into overbought territory. You listening likely know how RSI functions as a momentum gauge, but the implication of sustaining an RSI over 71 at this altitude is what we really need to focus on.
The implication is institutional mean reversion. Institutional trading algorithms are programmed to recognize when an asset's price has deviated too far from its intrinsic moving averages.
So it's rubber banding.
Yes, think of the distance between the current $925 price and the $607 200-day moving average as a stretched industrial spring. The further the price accelerates upward, the more tension builds in that spring. An RSI of 71.32 is a mathematical trigger warning that the tension is reaching a breaking point. Short-term profit-taking isn't just likely, it's mechanically inevitable.
So if a technical pullback happens, where is the floor? We have immediate support levels at $901.24 and $900.50. If the selling pressure breaks those, the secondary support drops down to $867.76. But what if the buying frenzy just continues?
If the momentum completely ignores the overbought signals, the next major resistance level is calculated way up at roughly $1,020.30.
$1,000? That's insane.
Technical analysts refer to that level as the fan theory trend top. It is theoretically possible to hit that, but the mathematical probability of a violent algorithmic sell-off increases exponentially every single day the stock lingers in this overbought zone.
This is where the story gets really compelling. The charts are showing a massive upward frenzy. The company is generating incredible levered free cash flow. But when we look at the analysts whose entire job is to build valuation models and the company insiders who actually run the business, they are painting a drastically different picture.
It is one of the starkest divergences in the market right now. The technical momentum is actively warring against the fundamental valuation models.
Despite this stock rocketing to $925, the broader analyst consensus rating is a mere moderate buy, and the price targets are almost shocking to read. The average professional price target is $623.50.
Which means the consensus of Wall Street analysts believes the stock is currently trading with a 32.65% downside risk.
A 32% drop. Even the most bullish analyst in the Data BWS Financial Peter only has a target of $720. Barclays holds the lowest target down at $527. The stock is completely decoupled from every professional expectation. Why?
It comes down to the multiple. Right now, UI is trading at a price-to-earnings ratio, a PE, of 63.18.
Oh, wait, let me challenge that for a second. We see companies in the AI and tech sector like NVIDIA or Palantir trading at astronomical PE multiples, often well into the 80s or 90s, and their stock prices continue to climb.
Sure they do.
So why is a 63x multiple considered a death sentence for Ubiquiti if they are providing the crucial networking hardware required to move massive AI datasets?
Because of the structural limitations of hardware growth versus software growth, when a software company trades at 80x earnings, investors are betting on frictionless scalability. But Ubiquiti has to physically manufacture and ship units.
Right.
A 63x multiple on a hardware company means the stock is priced for perfection.
Explain that mechanism. What does priced for perfection actually mean for the person holding the shares today?
Imagine buying a residential property for double its current market value because you are banking on a massive tech hub being built in that neighborhood 10 years from now. You aren't paying for the house as it exists today.
You're paying for the potential.
Right. You are paying a massive premium for an assumed flawless future. Ubiquiti expects around 16% profit growth next year. That is fantastic. But at 63 times earnings, the market has already fully priced in that 16% growth, plus several more years of flawless execution.
Meaning, if they suffer a single supply chain bottleneck in Taiwan, or, miss a quarterly revenue estimate by even 2%, that perfection narrative shatters.
And when the narrative shatters, the multiple compresses. The stock price can plummet 30%, even if the underlying company is still highly profitable and growing. The analysts are modeling their $623 price targets based on where the stock will settle when that premium multiple inevitably compresses back to a realistic hardware industry average.
Here's where it gets really interesting, though. If the company is doing so incredibly well, why are the actual insiders hitting the sell button? Let's look at the insider trading logs, because this is where the red flags turn into claxons. Insider sentiment is distinctly negative. Executives have engaged in significant open market selling, offloading $1.51 million in shares across 100 separate transactions over the last year.
This raises an important question, though we always have to be careful with insider selling because executives sell stock for mundane reasons all the time, paying taxes, buying real estate, diversifying portfolios.
Sure, of course.
But the volume and frequency are what really matter here.
Right. One executive selling $1 million in a single scheduled 10b5-1 block trade is standard diversification. But 100 separate open market transactions across multiple insiders without any corresponding open market buying to offset it paints a very specific picture.
It suggests that the people looking at the internal order books and the supply chain data recognize that the current $925 share price has fundamentally outrun the company's realistic near-term earning potential. They are capitalizing on the retail momentum to secure their own liquidity.
Which brings us to the core debate of this deep dive. Is Ubiquiti an undervalued, misunderstood AI infrastructure play, or is it a classic value trap waiting to crush retail traders? Let's build the bull case first.
The bull case relies entirely on the macroeconomic shift toward artificial intelligence. AI large language models require unprecedented data throughput. You simply cannot run next-generation AI on legacy routers and switches.
So the bulls look at UI's 30% profit margins and their massive cash generation, and they argue that the 16% projected growth is actually a massive underestimation.
Exactly.
They believe the global upgrade cycle for networking infrastructure will cause Ubiquiti's earnings to explode upwards so violently that the 63 PE ratio will rapidly drop down to a normal level. Not because the stock price falls, but because the actual earnings catch up to the price.
But then you have the bear case. The bears look at that exact same 30% net margin, and instead of seeing strength, they see an irony that creates a structural ceiling for the stock.
I want to focus on that irony, because it is the most crucial insight in these sources. Usually when a company has a high PE ratio, a new CEO can come in, fire underperforming sales staff, renegotiate supply contracts, and artificially boost earnings by cutting the fat.
Right, the classic turnaround playbook.
Exactly. But Ubiquiti is already operating at peak efficiency. They don't have a traditional sales force to cut. They're already pulling 30% net profit out of hardware. There is literally no fat left to trim.
Exactly. And because they cannot artificially manufacture earnings growth through cost cutting, they are entirely dependent on sheer brute force revenue expansion to justify that 63x multiple. If the macroeconomic demand for networking gear slows down even slightly, their earnings growth stalls, and the stock price collapses to meet reality.
It feels like the retail traders buying in right now are completely ignoring that ceiling. I mean, retail sees that 19% two-week gain. They see the RSI flashing green candles, and they scramble for a seat right as the executives are taking their profits and leaving the party. FOMO is a powerful thing.
It is, and mechanically they are buying the top of a parabolic curve, providing exit liquidity for the executives and institutional players who are quietly unwinding their positions.
Ouch.
Yeah, that is the exact anatomy of a value trap. Retail traders assume the momentum is infinite, but when institutional algorithms trigger a sell-off based on that overextended 200-day moving average, the downside isn't a slow, gentle drift.
No, it's a cliff.
Right. When parabolic stocks snap back, the resulting drop is usually violently fast, trapping anyone who bought near the top.
So, synthesizing all of this, the cash printing fundamentals, the overbought technicals, the massive multiple, and the insider selling, what is the actual roadmap for this stock moving forward?
If we connect this to the bigger picture, we really have to bifurcate the timeline. In the immediate short term, technical momentum is a powerful force. The trend is undeniably upward, and day traders might still exploit small intraday movements.
Sure.
But the risk-to-reward ratio is incredibly dangerous. The mechanical tension on the RSI and the deviation from the moving averages means a sudden, sharp pullback is looming.
And looking at the medium to long term, the sources confirm a generally bullish macroeconomic outlook on networking demand. But analysts are raising questions about whether the current spike in corporate IT spending is actually sustainable, or if it is just a temporary panic buy by companies desperate to label themselves AI ready.
The market isn't going to wait long for an answer. The next major catalyst is the Q3 earnings report, currently estimated for May 8, 2026.
That May 8th date is the true test. That earnings call will definitively prove the bulls right, showing that revenue is accelerating fast enough to justify the 63 multiple. Or it will prove the bears right, triggering the multiple compression the analysts are warning about.
It forces investors to choose their underlying philosophy. Are you trading the chart and the momentum in front of you, or are you trading the fundamental valuation underneath it?
And I want you, the listener, to really think about that. What stands out to you? Are you trusting the undeniable velocity of the MACD and those flawlessly efficient 30% margins? Or do you trust the analyst consensus targets and the insiders taking their cash? To summarize exactly what we've discovered today, Ubiquiti is undeniably an operational marvel.
Unquestionably.
They have managed to build a nearly $3 billion revenue engine with software-like margins in a traditionally low-margin hardware space. Their levered free cash flow is so strong, they are literally paying shareholders to stick around.
But the chart.
Right, but the stock price itself has violently decoupled from that reality. We are looking at a technical rubber band stretched to its absolute breaking point, a massive 30% downside risk according to professional valuation models, and a 63x multiple that demands flawless execution in a really volatile macro environment.
It is a company operating at peak performance, attached to a stock price that has temporarily abandoned mathematics.
Well said. Before we wrap up, I want to leave you with one final provocative thought to mull over. We've spent a lot of time dissecting why a 63 PE ratio is historically dangerous for a hardware company. But considering the unprecedented scale of the global AI infrastructure build-out, is it possible our historical baselines are just, well, obsolete? Is Ubiquiti's extreme valuation an isolated anomaly destined to crash? Or are we witnessing a sector-wide paradigm shift where massive premiums are simply the new standard for networking hardware companies powering the AI boom?
If the underlying macroeconomic rules of hardware valuation are truly being rewritten, then the historical model's warning of a crash might be entirely miscalibrated.
And finding those edge cases is exactly why we tear these sources down. Remember, everything we explored today was an educational debate on market mechanics, absolutely not financial advice. Thank you for joining us on this deep dive. Keep questioning, keep learning.